Today, will the Reserve Bank of New Zealand be forced to cut rates later? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian and New Zealand flavour. Well, as you know, the Reserve Bank of New Zealand is aggressively raising the cash rate at the moment, and the expectation from the bank is they will continue to do this for some time. But new research suggests that the Reserve Bank of New Zealand will be forced to slash interest rates in the second half of next year in the face of a tanking housing market. And this is based on research from the independent global researcher Capital Economics. Capital, which has been forecasting since January this year that falling house prices will force the Reserve Bank's hand, is now predicting New Zealand house prices will drop by 20% by the middle of next year. And it says the reaction will be 3 cuts to the official cash rate, totalling 75 basis points in the second half of 2023. Capital Australia and New Zealand economist Ben Udy, who was early last year first to forecast that the Reserve Bank of New Zealand would need to start raising the official cash rate, says house prices in New Zealand are tumbling and all signs point to a further deterioration in the months ahead. On that basis, we are revising up our forecast for the peak-to-trough decline in prices from 10% to 20%. That's why we expect the Reserve Bank of New Zealand's hiking cycle to go into reverse earlier than most anticipate. We were one of the first to forecast a significant housing downturn in 2022 when we made the prediction a year ago. REINZ median house prices have been generally falling since November last year and are now more than 5% below their peak. Prices are still higher, though, than they were a year ago, but the weakness in sales indicates that the downturn is set to intensify. That suggests that our forecast of a 10% peak-to-trough fall in prices is far too small. And they said, since making the earlier forecast of house price falls, the outlook has deteriorated. First, we now expect the Reserve Bank of New Zealand's policy rate to peak at 3.5% instead of a peak of 1.25% that we'd anticipated last year. And what's more, the government's introduced responsible lending laws that contributed to housing credit growth slowing from 12% year over year in the middle of last year to 8.7% in March. Admittedly, they say our previous expectation that the Reserve Bank of New Zealand would implement debt-to-income restrictions now looks unlikely, but we were right that housing affordability was set to become more stretched than ever before. And in the months ahead, rising interest rates will more than offset the impact of falling prices and stretch housing affordability even further. In a global outlook on houses in March, Capital Economics has singled out the New Zealand housing market as one of the ones that they're most worried about. They note that New Zealand has experienced just one significant housing downturn since the 1990s, which occurred in 2008 following the global financial crisis. Our forecasts for interest rates would be consistent with prices falling 15% year over year before long and keep falling until around the end of 2023. That suggests the downturn may result in a 20% fall in prices. Even such a large drop in prices would only, though, restore affordability to its late 2021 levels or its pre-GFC peak, which would still be very stretched. The Reserve Bank of New Zealand recently indicated that house prices would become sustainable if they were about 5 to 20% lower than they are currently. And last week, when hiking the official cash rate to 2% and signalling the official cash rate could hit nearly 4% by the middle of 2023, the Reserve Bank of New Zealand said it saw house prices falling from a peak to trough of around 15% by 2024. Now, Udy still expects the RBNZ to continue hiking rates before the end of the year. He believes the housing downturn will be a drag on the New Zealand economy, and the hit to construction activity will grow as both the length and the depth of the downturn increases. But the deeper downturn will have more severe implications for recent home buyers. The Reserve Bank of New Zealand estimates that if house prices fell by 30%, then 10% of mortgage holders will be underwater. That is, they will have mortgages that are larger than the value of their homes. That situation can lead to an increase in defaults. Admittedly, a 30% price rise would be much larger than we anticipate, and defaults are currently very low, so a small rise wouldn't be a significant concern for the financial system. But we suspect that even those underwater households that avoid default will tighten their belts considerably. That's another reason to expect a slowdown in consumption growth in the years ahead, Eddie said. By the middle of next year, he thinks the impact of the housing downturn will be painfully clear, and we think house prices will be at the bottom of the Reserve Bank of New Zealand's estimated sustainable range. On that basis, we think the bank will cut rates by 75 basis points starting in the second half of next year. That should be enough to stabilise the housing market and support a rebound in GDP growth. And of course, they should have also mentioned the opening of the migration taps that happened quite recently. And of course, the government's now also provided more stimulus and support to try and pull first-time buyers into the market. So already there are early signs of concern, at the political level at least, about what's going on here. So the bottom line is this: sure, rates are definitely going to go up, but precisely how far they rise, how long they stay high, and when they come down again is certainly worth watching. We have the view that rates will come back down, and maybe sooner than many think. But we'll see. Remember, of course, the Reserve Bank of New Zealand is tackling a very strong inflation number, and that inflation is definitely embedded, and it may take a lot longer than many people think for it to be tamed. So there is a big trade-off here: tame inflation or crash the economy. Central banks have dug a rather big hole for themselves, and neither is an easy step from here. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.